We are fortunate today that we have our next panel coming up, the first of our conversations, if you will, to look ahead, to bring us some of their vision, some of their long-term strategy, so we can determine a path forward in the new economic order. Leading the panel today is going to be Dr. Eric Yip, the Executive Director for Intermediaries with the Securities and Futures Commission from right here in Hong Kong. Jean Hynes is the CEO and Managing Partner at Wellington Management. She's going to be joined by Eric Schlossberg, who is the President and CEO for Invesco. Also joining them is Eric Stein, the Chief Investment Officer with Voya Investment Management. And rounding it all out will be Hendrik, who is the founder and CEO with 91. And with that, Dr. Yip, the floor is yours. Please, let's welcome them.
Can you hear me? Yes. This is a great day here, and I don't need to do the introduction because we have all of our panelists, distinguished panelists, introduced. The one thing that I want to supplement is that they are all from my favorite cities. We just talk about that. So we have Jean and Eric, also a very good name, from Boston. And then Andrew, also from my favorite city, because in Atlanta, my favorite football team, New England Patriots, came back from the biggest comeback in all time in 2017, beating the Atlanta Falcons. And Hendrik, I didn't tell you that my best friend is actually from South Africa. So you guys are cool, yeah. So, and my boss is downstairs, and also my whole board is downstairs. But Julie said that I'm supposed to be entertaining, but I'm not. I'm in regulator now. So we are talking about very serious stuff, new economic order. And I try to set the stage to talk about geo-economic fragmentation. Just quote some figures. According to a WTO report, there has been like 1,300 of trade barriers being introduced since 2019 and 2023. That's a significant increase from previous years. That result in about 12% drop in foreign investment, 12% drop in the trading blocks between China and US. A lot of the multinationals are thinking about reshoring. Now, if you talk about trade barriers, to me, it's more a result. If you look at the cost and consequence analysis, that's more the consequence, the results. I want to start first exploring what are the reasons for trade barriers. And then if you have to predict, is it going to get worse, better, or more or less the same? Why don't we start with Eugene?
So I think the part of the reasons for the trade barriers, if I have to take a big step back, if I go back to earlier this year when President Trump of the United States announced the tariffs, I would say it was done in maybe an imprecise way, but there are probably some reasons behind. If you take a step back and what is he trying to solve for? There's over time things happen that create anomalies, and I think probably in Europe it was defense, right? Defense was one of them. I've been a healthcare investor for over 35 years, and one of the anomalies as well has been how the U.S. funds almost all of the research. It's starting to happen in this area as well. I'm very excited about the future of biotech in China and Hong Kong. It's super exciting. But right now, the U.S. and the U.S. population actually funds, through drug pricing in the U.S., funds all the research now that happens in bringing new medicines to the world. And so that's an anomaly, right? So you have these anomalies that have existed. And so part of the blunt instrument of the tariffs is trying to solve for that, but it's trying to solve for it in a very blunt way. But I think those are some of the things that are behind some of the moves that we've seen this year.
All right. So Andrew, down from Atlanta, you think this is going to get better, worse, or pretty much the same?
Well, first, thank you for having me again here. Thank you to the HKMA. I'm going to take the less popular position on this and say we'll look back in 10 years and fragmentation will be better, and we'll look back and we'll see a connected global economy, connected global markets. I just don't think we can go backwards, and I think innovation, technology, and frankly, the consumer is what's going to drive it.
All right. So, Eric, your view?
Yeah, I would say, to me, two main points. Just the concept of tariffs, and this was a big takeaway I had when I was down at the IMF meetings in Washington last month, is here to stay from a U.S. perspective, unless we get a massive sea change of a traditional center-right or center-left party back, and I don't see that right now. So tariffs, I don't like them. I'm a free market person at heart. I'm in Hong Kong. Thank you again for having me in the kind of the center of free markets. But tariffs are here to stay from a U.S. policy perspective. I think it's going to outlast the current administration. So I'd say that's number one. And then number two, maybe I'll disagree with Andrew, is really this U.S.-China fissure, to me, is structural. There can be cyclical up and downs. Now seems better post the meeting with Trump and Xi, but I think there is a structural fissure. I still think we're in an era of globalization. We're not deglobalization, but I'll say we're in re-globalization with these two distinct economic blocks, and then some countries that are more unaffiliated, maybe in a third block.
All right. Thank you, Eric. And Hendrik, you have the last say.
So, my name's not Eric on the panel, and I wasn't called Eric by the first speaker, so I'm all right. And I can therefore be slightly different. I grew up in an emerging market. I grew up in a world where the West preached a certain orthodoxy until they got competed out of existence, and then they changed the rules. That's what's happening here. And it's driven by domestic politics. It's driven by weaker, by issues at home, and therefore not global issues, and therefore we're going to have a different globalization, but we're all going to understand that nations are driven by their own interests and their own domestic interests rather than this idea of a fair global order for all imposed by a benign hegemon. So that means you've got to understand what happens inside each region, each country when you invest, because that's going to drive the policy logic. I don't believe we're going to have a continuation of Chimerica, but globalization has always been with us, will always be. People have traded with, if you just go to the Middle East where I was last week, you just know that Arab traders have traded with Africa for thousands of, more than 1,000 years. That's not going to change. And therefore, we just have a more nuanced, more subtle world, and we need to do a great deal as investors, more bottom-up work, because that simple model we had, interest rates fall after Volcker forever, inflation is under control, there's one sort of simple, there's a dominant currency which isn't going to have cycles of weakness, which was we've come out of a 23-year dollar positive or dollar cycle, of which the last, I think it's 14 years have been positive. That's also going to change. So a really interesting world ahead, but thank you for having us here. I really appreciate being here.
Thank you, Hendrik. I like the fact that it seems like the panelists have different views. That means that one of you will be correct in the future. So, and indeed, we are trying to answer questions that may not have a simple answers. And the fact is that we are living in a very confusing world. Now, while we talk about geo-economic fragmentation, the confusing part to me is that I also see that the world we are living in seems to be more connected, seems to be more borderless. Look at consumers. Consumers now are spoiled. I mean, they are very digital savvy. They can shop around. They can always bargain for the best deal. My wife has been recently addicted to PDD. So I just introduced that to Jean. I mean, she has not heard of it. And then I know her behavior because she is using my WeChat Pay. So I can see every day, basically, in a period of 30 seconds, I see payment of $5, Hong Kong dollar, renminbi, $15, $20, $30. And I said, that's fine, that's not a lot of money. But a few days later, I see stacks of goods appear on my doorstep. And you know, in Hong Kong, our apartment, we are living in an apartment, which is quite small. So I now need to find a place to store those PDD goods. And that become a very expensive problem. So that's how consumers have been. So, I mean, people blame inflation here and there, but they are actually buying things like dirt cheap, like globally. And on the other side, I used to be in private equity and banking. I saw corporates being destroyed by this globalization and this kind of new order. The business model evaporated, and then the newcomers coming in. Well, I think this become a very, very complex supply chain environment. So I will start with you, Andrew, because you have heard of PDD and multi.
Yeah.
So what's happening to consumers, producers, and distributors? And since you guys are all from the buy side, you look at the companies, talk to corporate executives, what are they worried about, and what are you looking for?
Yeah, it's an important question, and I think everybody will want to share, so I'll try to be brief. I think if you think about the consumer, and I'll start in the U.S., the fear of inflation, which we haven't fully seen, is top of mind. And the consumer, there's many kinds of consumers in America, but there's at least two kinds, and they're pretty bifurcated. So if you owned your home and you were invested in the stock market over the last 5 years, you have a lot of purchasing power, and you'll be able to withstand maybe some of the inflation that's in the system. If you're the other side of that, you know, the economy is struggling a bit. And I think that's where the Fed is really trying to sort through what's going on there. So the consumer behavior is quite different there. And then when you look at China, you know, all the discussion, at least I was picking up, is around the fear of deflation. So we've got these sort of polars that are going on around the markets. When we, you know, speak to corporations, you know, one of the things that's on their minds is looking through all of this volatility, looking through all this uncertainty, whether there's trade barriers extending, whether we're going to re-globalize or de-globalize, and long-term commitments of investments are relatively anemic. And then if you look at the investor, especially the individual investor, there is a lot of cash still on the sidelines. So I think I'd say watch inflation or deflation, and there goes the consumer.
So what's your view, Eric? I mean, inflation, deflation, which factor is going to override the other? And I think also important is that when you look at the different sectors, are there particular sectors that are being more affected, or there are more opportunities?
Yeah, so no, great question. Just maybe to build on a little what Andrew said, there is a regional difference. So in China, to me, just as someone who traded Chinese bonds maybe 10 years ago, Chinese bonds with a one handle is very different from where they were, particularly given the rate sell-off we saw globally in 2022, which we've come off the highs in most developed bond markets with movements around. And so that's just showing me in China from a market indicator perspective with CGBs in the mid ones that it's a deflation challenge, not an inflation challenge. From a U.S. perspective, if you go back 3 years, if you go back to 2022, it was the first time probably in 40 years that inflation was a big political issue. It largely drove, I think, the 22 midterms. It had significant effects in the 2024 presidential election, and we're not fully out of that. We're somewhat out of it from what a bond geek would look at, year-over-year inflation that drives the treasury market. But to me, from a political economy perspective, it's what people pay for basic goods and services, particularly food, energy, shelter, things of that nature. And the price level has come up, even if the rate of change has slowed. So that has both political effects and, to Andrew's points, has economic effects, because those typically are not the consumers that have had the house price and asset market inflation. So that's on the consumer side. And then from a corporate perspective, to me, the most interesting thing really is the supply chain, something you heard almost nothing about until until COVID. COVID really got companies and particularly investors focused on all the supply chain issues. And then even now with the tariffs and the back and forth between the US and China, corporate executives that are manufacturing from a global supply chain are more focused on it. I think we're getting, again, from this economic fragmentation perspective, somewhat more fragmented supply chains.
Right. So I know Jean and Andrew, you heading to Tokyo. Is it? Are you also, Eric, going to Tokyo? No, Hendrik, you're not going to Tokyo. But in Tokyo, you kind of see a bit of that. You're probably going to pay outrageous price for your hotel. But then you look at the food. The consumer goods, they are actually dirt cheap. So that's actually also, even within a single economy, you see a bit of both sides. And that's kind of, you see the property and the non-profit sectors behaving differently. And whether you're owner or not owner, that actually affect a big time on your behavior. Hendrik, you are the entrepreneur on the stage. Really, I also observe a lot of new entrepreneurship in the world because there's a lot of disruptions going on because of the new order. If you look at companies, if you look at sectors, how you analyze from an entrepreneurial point of view?
I mean, some marketing guy, and I still have to give him credit, but when he invented the sort of strap line, investing for a world of change, I thought that was great when he came up with it. And I realize how difficult it is, how fast change is, how the world is accelerating. And it's not just AI. We spoke a lot about that yesterday. Quantum's coming after that. The way we do things will change fundamentally, and that's what I really enjoy when I come to China and I see the creative kind of entrepreneurial part or fintech part of it. And I'm very fortunate to have been on the board of a very large investor, the largest in Tencent for many years, and I sort of view it from that point of view. So for me, if you invest in businesses, you've got to invest in businesses where management have that entrepreneurial streak that they can move fast enough with the times. Backward-looking institutionalism, which is essentially plaguing our industry, is something which is going to be, you're going to pay a heavy price for that. So I'm very excited, and what I'm really excited about, if we were sitting here, I was thinking about it this morning, if we sat here 50 years ago, when Larry Fink started in finance, this would have been a colony. It was largely British audience talking about British companies dominating the area, trading with China. 50 years, if we were here over 60 years ago in the Middle East, Abu Dhabi would have, in fact, in 1961, Abu Dhabi had one building. One. Go look at it today. So the talent that is coming from what I call the rest of the world, the 7 billion, not the 1 billion, is enormous. And if we can find that entrepreneurial talent, and a lot of it's right here, being encouraged by this kind of environment, and if you go north of the border, you see it live, you see it happening in front of you, so we have more choice. That's I would say. I would say the opportunity today is more choice to back more entrepreneurs in more places and get the diversity in your portfolio that you probably lacked in a world which is dominated by a single economy or a single economic system. That to me is what excites me about tomorrow.
So Hendrik, you're absolutely right. I spent the last 15 years in China before I joined the commission. I gave up because, there's a term, used to have a term called 996. That means you work 9 to 9 for 6 days. That's no longer the case. The new term is 007. So, and it's actually true. The scary part is that. So if you, after your multi-fist, you go back to your office, you will see your boss, which is the entrepreneur, still working. So that's actually how competitive, scary, and how hardworking entrepreneurs are. Jean, you have a very impressive career. I did my homework in the sense that, you actually grew up in Wellington as an administrative assistant, and then you grew into research. Am I right? So,
right.
And in your research mind, how do you make sense out of this economic order when I talk about like the consumers, distributors, and producers, and the fact that I think disrupting companies here and there. How do you research that kind of dynamics?
So I did grow up as a researcher. So one of the interesting things is sometimes I'm on panels and people want me to talk about the macro, and I always go to the micro. So I always go to the micro because that's where I spent the last 35 years, at the micro. And I obviously did that in biotech and pharmaceuticals. And at Wellington, we do it on the micro level across all sectors. So I'll make one comment about the consumer and then bring it back to corporates. In the last month, I've had the opportunity to just interact with CEOs that interact with all the consumers in the US. And what they're seeing is that in some ways nothing has changed. There's like 3 or 4% growth of the consumers, and this is companies like Visa and Bank of America. They have such a great window into the U.S. consumer, but at the same time, they're changing behaviors, right? Because clearly, if I read notes or I listen to our morning meeting, restaurants are quite weak. So there's some change in behavior that's happening, and so that's what we do then, right? So that's what we do. We try to figure out there's that macro spend, and then where is that spend going? And that just means interacting with all the corporations across the globe in this region and in Europe and in the U.S. to try to figure out and build the mosaic of where that spending is going and where there's change happening. And that's what that's what we do for a living. That's what I've done for 35 years, and I think it's a particularly interesting time when you combine tariffs. I'll tell it one quick story. I was with a number of CEOs across all industries in April, and I was on a panel like this, and it was very gloomy at the beginning of the day, talking about the impact of tariffs. And then when I was on the panel, people started smiling, and I'm like, wow, they are very interested in what I have to say. And then towards the end of the panel, the audience announced to the speakers that the tariffs had been lifted temporarily. And so I wanted to share this enormous relief that went across the faces of 50 CEOs. And so within minutes, within minutes. And so now it's time. So you have the tariffs, you have AI. There's just enormous change. I feel it as a CEO myself. There's just enormous headwinds, tailwinds that are coming for corporations to help navigate that will change the earnings picture. Ultimately, it comes down to earnings. It will change the earnings picture of the world in the next 10 to 20 years. And so that's where deep individual research will really come in to try to differentiate where the world is going and who's going to benefit. And I think it's going to be a super exciting time for us as researchers.
Well, very interesting. I was actually in Cadiz, Spain, on Liberation Day. So I was surrounded by blue sky and white beaches. And it was very chaotic, but then I didn't receive any phone call from my colleagues. And the day that I come back, everything seems to be normal. So we can research on a lot of events, but it seems like events take care of itself as well. So we need to kind of maintain a certain coolness, not to be hyped up by the noises. And then I want to switch to a topic that is very hype. We have 7 minutes left. I promise the panelists I will leave at least 3-4 minutes on the last part because every one of us want to hear their investment advice. But I want to talk about one more topic, which is AI. So AI is so hyped up in a sense that everyone has their own opinion. I want to make it more interesting because I want to put my best on the table first. I would review my view on AI. I believe in mean reversion. I grew up in securities market. I grew up in investment market. I believe in mean reversion. I believe in economics, bottom-up researchers. I don't believe in hype. And I really, when I come to AI, to me, I believe in AI, but I think most ventures at the end of the day will fail. Just like what IMF has weighed in recently, saying that this is very much like the dot-com bubble. Now, my question, we only have like 2-3 minutes to talk about this. Is AI overhyped, or is AI Taylor Swift, which means they will stay hot forever? Hendrik, you are the entrepreneur.
It's absolutely not overhyped. Maybe the markets are overhyping some AI stocks. That's different from saying the impact of AI is over. This is a change which is going to be massive and has only started.
That's great. Eric?
Taylor Swift, full stop.
All right. So,
And as a father of a teenage daughter, she'll be proud that I brought up Taylor Swift on a panel.
to be honest, for the record, I was bearish on Taylor Swift when she was out.
You
I don't
were
like her
short
music, so I
Taylor
was
Swift.
wrong. Yes. Yes. Andrew?
I've been to a Taylor Swift concert, and I can definitely say it's transformative and it's not overhyped, and I'll say the same for this. The only thing I'll say is, with any major innovation change and any transformation, there are going to be misses and there are going to be places where it might get overhyped, and I just think that's a feature of innovation, not a bug.
All right. Jean, you have 4 daughters.
4 daughters who
Taylor Swift or not?
grew up with Taylor Swift, and I went all over the world to bring them to the Eras tour. Went 3 times.
Right. Yeah. And you enjoy it?
I'm a Swiftie. Become a Swiftie. I was a driver in the front of the car for 15 years, and then now I'm a Swiftie.
All right. So AI, is it Taylor Swift or not?
AI is definitely Taylor Swift.
So Taylor Swift. So 4 against 1. So in the sense that I have been proven wrong in Taylor Swift, I probably will be proven wrong in AI, just because I think at the end of the day, I do believe in technology, I believe in AI. It's just that also I'm very scary when people kind of get excited just by the mentioning of the term AI and Gen AI. So that is something that we try to
Couldn't
avoid.
agree with you more. Yeah.
So there are still some pretenders, some kind of for real. Yeah, last, we have 4 minutes, 1 minute each. Investment advice, and that's, again, in our pre-meeting, our panelists is very sensitive in the sense that because I'm a regulator, they're not going to talk about things that have conflict of interest. But I mean, I'm testing your also compliance culture and compliance mindset. So Eric, start with you. You are the new CIO.
Yeah, we have a strong compliance culture at Voya. So advice, maybe just some opinions on markets. And I really liked what Mike Gitlin said yesterday, more focused on 2036 than 2026. But I'll start with 2026. Even though I think AI is Taylor Swift, I'd actually buy the S&P 493, kind of X the Mag 7 on a 1-year view. But on a 10-year view, I think things that the world is short, compute and energy, are really good places to invest. And then to bring it back to the panel of economic fragmentation, I think the dollar still has a lot of reasons to exist and be strong and be used. But at the margin, we are in a world of de-dollarization, of more hedging of dollar assets in this and other parts of the world. So I think we're likely in for a weaker dollar, similar to what we've seen this year.
Andrew, Invesco's view.
Yeah, I'm going to go caveat with all the compliance. I'm going to go with basically 2 simple principles that we were all taught at the beginning of our careers, and maybe sooner, will feature in 26, and that's be heavily diversified and keep some dry powder for many of the reasons that you just said. The narrowness of the markets over the last several years means that there's going to be a broadening out where rates are potentially going or likely going. EM, smaller cap, mid cap are all places where I think people have been underinvested and they're going to catch up. And then in terms of keeping the powder dry, I think there is some point where we're probably closer to a correction than we are to 10%, 20% up from here. There will be opportunities to work your capital, so have enough liquidity.
Jean.
So I 100% agree with the 493, and I don't think it's just a 1 year. I think it is probably multiple years, and that doesn't mean that I thought the energy panel yesterday was probably one of the most fascinating, where I learned the most, and so clearly the amount of energy needed and the ability for those companies to make money will still be strong. But I think what's missing in all the analysis is is how AI is going to impact this is not the internet. AI, I love the analogy of it's electricity. It's going to impact every single company in the world, and those companies are trading at much lower multiples than those 7 stocks. And so I think how every company benefits from innovation with AI efficiency will, I think, bolster the PE and the earnings of companies around the world in ways that we probably don't realize yet. And so being more active, and I know I'm talking our book, but I do think being more active, being more diversified is probably the way to go in the next multiple years.
I'm going to be unashamedly talking my book. It's diversification from the dominant market today, a new dollar cycle, which I'm not thinking the dollar is going to disappear, but there is a dollar down cycle starting. There's a massive asset diversification away from the US starting, going into smaller markets. There's an entrepreneurial boom in Asia, particularly in China, which we need to get. And then, of course, energy. I don't know how to access it at the right price, but it's a hell of a lot cheaper than AI. And then finally, really being short on governments. So in other words, the world lived off government debt for a long time. Back the private sector in this complicated world and you'll win.
Okay, I still have 14 seconds. I'm going to steal 30 seconds from the audience. In 3 seconds, tell me what you like about Hong Kong, Jean.
I love the dynamism. Just an energy.
Energy. Andrew.
I like seeing a lot of young people back out and about in Hong Kong.
Eric.
Free markets and Lang Kwai Fong.
All right.
Free markets, food, and fun.
All right. So we should give a round of applause to our distinguished panelists. Thank you very much. Thank you very much.